Hi, this is Andrew from XO Capital. Today I'm going to be talking about maybe having a thesis for our acquisition group. So at XO, we buy small, profitable SaaS companies and take them over and operate them. Today we're going to be talking about a thesis. I don't know if it's quite a thesis. Thesis isn't the right word. If you look at some of our previous posts, I don't have one necessarily for XO. It's been a lot more opportunistic. There's plenty of reasons for that. But in theory, we're supposed to be buying boring SaaS businesses that cash flow slowly and consistently. On the small end of the market, it's just really challenging to do that. I mean, if you buy one company that's making $5,000-$10,000 a month, you really just can't staff it very well. There's just not that much money to go around. And so we have a shared services model. So for our current portfolio, we've done 7 total acquisitions. We currently have 4, so we've sold off 3. So we're actively operating 4. They're all product-led growth type companies now, but it wasn't always that way. So we had bought a small B2B enterprise SaaS company. In this case, it was an XY Combinator startup that just failed to hit scale, but was generating some revenue, and we took that over. So as an example of how challenging it is to do this with enterprise SaaS companies, this particular one was called WorkClout. Its product was for doing inspections. So we were selling to manufacturing companies that made, engines, etc. So when people first hear of the concept of private equity or even micro private equity, that's what they think we do. And they're not wrong, but it's not quite right either. In this early stage, right, so that company was making about $100,000 a year when we bought it. That cash flow was also lumpy, so it wasn't like we were getting, 8,000 some odd a month. It was very lumpy. So, we might get 0 for 3 months, right, and then a larger check for another month. So managing cash flow on these things is also not maybe as straightforward as it looks, because when you go into Stripe or whatever and you look at the MRR number, that is not necessarily the amount of dollars you're going to get that month. Oftentimes it's not even close to the numbers that you're going to get that month. But in terms of operations, that enterprise SaaS company, we needed to handhold a relatively small number of customers. So let's say there was under 10 customers. Each one of those was a high dollar amount. But if any one of those churned, it was really, really bad for the business, right? That was a bad day when one of those customers churned. On the flip side, getting a new customer like that's in 5-6 figures a year is awesome, but they require a lot of touch. So Danny had to spend and was spending an inordinate or disproportional amount of time talking to these guys relative to our product-led growth companies that had more of a freemium model. So you could sign up, there was a 2-week or 30-day or whatever free trial, and a certain percentage of those convert, and that's kind of how those things run. The PLG companies are much easier to operate with a shared services model. We can have content, so people doing content for us. We can have engineering, so all of our engineers happen to be in South America, and they are switching between portfolio companies and working on different tasks. We, of course, try and optimize this a little bit, but for the most part, they might have spent a few days working on one product and then a few more days working on a different product, and they have to context switch a lot, which in some ways is fun as an engineer working on that thing. I always liked that, but you definitely do lose some efficiency when you have to switch. So back to the thesis, even on sales cycles in the enterprise SaaS companies, that process can take up to 12 months. It's just like a really long sales cycle. So, that's obviously not as good as some of these product-led growth companies where somebody might sign up and pay that same day, right? That happens all the time. So in certain ways, our thesis, or this kind of maybe thesis, is really looking for where we're going to be finding alpha, given that we are buying really, really tiny things. A lot of these problems go away if the enterprise company gets a little bit bigger. So in enterprise SaaS, if it's making $1 million a year, and let's say there's really high margins, you can actually start to staff that. And the second that you can hire a CEO, like buy a company, hire a CEO, staff individual people just to work on that company, I think a lot of our problems, or the problems that we've been having in terms of shared services, et cetera, go away. Obviously, other problems arise. I'm not saying that's easier in any way, but it is different, and it is not as the restriction on how many people we can hire to service how many companies. That sort of math goes away once we can effectively staff a company even minimally, right? Even being able to buy a company, put a CEO in place, have one engineer and one, I don't know, growth person or whatever, customer support or whatever that business needs. Even that would be a radically different model than how we have to operate today when buying these really tiny businesses. So back to the thesis, we're looking for alpha. So alpha, if you don't know, is sort of like the excess return or the abnormal rate of return. So in normal private equity stuff, like let's say we're buying boring, quote unquote boring software companies or enterprise SaaS companies or vertical SaaS companies, I wouldn't say that that's relatively low alpha compared to what I'm about to talk about. The expected return is not that you're going to, you of course could, but the expectation is not that you're going to 100x this or 1000x it. The idea is that these companies produce consistent cash flow and grow at a consistent rate that is maybe a couple percent month over month, which over time compounds and is a totally lovely way to build wealth. But that is not quite that is what I thought we were going to be doing, and that is not actually what we've been doing if I look at our history and our current portfolio. So when we're buying these PLG companies, let's say they have 100 customers, you don't really have to have any kind of relationship with them, right? You only hear from them when something's going wrong, or God, for some reason, these European companies just demand invoice receipts for everything, and they just cannot figure out how to go and get them themselves. So, but outside of that, on a relative basis, you don't hear from them that much. Whereas some of these larger enterprise customers, you might have like a shared Slack channel and be chatting with them all the time. And the expectation is if they ask for something, you're going to go build it. The surface area of those enterprise SaaS products is quite a bit larger than these product-led growth companies that we've bought. I like to describe the ones that we have and the ones that we're looking for currently as they have kind of a single promise to the user. So they kind of they're like a one-trick pony. They do one thing, they do it super well. They might go really deep on that one thing. That might be, there might be a long list of things for that one promise to be delivered on effectively, a lot of features in that area. But generally speaking, there's a kind of clear end to where the product ends. Whereas with enterprise SaaS, not always clear. A new customer might have an ad hoc integration that is required, et cetera, and that might be specific to them. It might not be. But it's often the case that with an enterprise SaaS company, you could be working on that thing till the end of time, right? And in many cases, a lot of these companies do. They have a lot of engineers constantly building features or new integrations, et cetera, for these enterprise SaaS companies. So I overestimated at the beginning how well we could execute on the enterprise SaaS playbook. We're bootstrapped, so we don't have any investors. And it's just the reality of it is that we are not able to really effectively execute on that. The PLG model with shared services works much, much better. So the other side of this, between some abstract concept of a thesis and what we could actually execute on, comes into play when we start looking at what's actually available for sale in the market today. So if you go on acquire.com and you go and you, put in some filters for some kind of revenue range of the things that you could possibly buy, there just aren't that many of them. So for us to also further cut down on that number of available opportunities based on some thesis makes it really difficult to actually get any kind of volume of deals done on an annual basis. We started with a really tight thesis and searched for 4 months without buying a single thing because it didn't fit the thesis. We missed out on some opportunities that we could have just bought, and I think they would have turned out quite well. And as soon as we relaxed that, we ended up buying 3 quite close to each other I think within 2 months we had bought 3. They have relatively little to do with each other. And that turned out to be fine. And since then, we've been operating on a much more opportunistic model. So our kind of buy box, these things are generally under 10,000 MRR. We're looking at stuff that's much bigger, right? Some stuff that's doing 30, 40, 50,000 a month. But generally speaking, they're run by 1 or 2 people. They've probably been bootstrapped. And that's sort of our buy box. So to say that we buy quote unquote boring businesses, I wish we could say that. I think that that's really cool. I just don't think we have the war chest to really execute on that because again, we'd have to be buying stuff in the low 7 figures. I think we could do one of those deals, but it would prevent us from buying additional companies for a long time. We would kind of just be having that one massive whale in the portfolio, which is not necessarily a bad thing. But when I look at what the opportunity is now, I think that we have an interesting play with buying these small product-led growth companies, again, founded by 1 or 2 people They're not even really full-time on these things a lot of times because, the dirty secret of getting to 10,000 in MRR for a SaaS company is that at least if you're living in the US, that's not enough. After taxes, after expenses, after some contractor fees, you just don't have enough. I don't know. Maybe I'm in LA, so maybe that's just why those numbers don't work, but it's just not that much money to be able to live off of. And so a lot of times people will sell because they want to move on to something that's venture scale and go raise venture, or they have a full-time job or other projects that they want to focus on. So that oftentimes is why they are selling the stuff. So notice so far in this whole thesis conversation, I haven't really talked about innovation. I think for us, for XO, at the moment, we're not talking about anything that's going to be, landing on Mars anytime soon. We're not looking for 1,000x return with these bets. We're looking to get profitable. We're looking to get break even on our cost structure currently. And, above all, I'm trying to make sure that XO is unkillable. And I think once we have a diverse portfolio of cash flowing companies that is at least break even, if not slightly positive, XO becomes unkillable in the sense that we're not going to run out of money, which is a huge killer of any kind of startup is running out of money. Now, whether we can end up generating excess cash flow and being able to buy more businesses, that's kind of what we're looking at above the profitability and break even angle. We're trying to figure out how can we get this flywheel going of buying businesses that cash flow enough to start building up a cash basis that we can then go use to deploy and buy further companies. Danny pointed out a few months ago that Constellation Software's growth was mostly through acquisitions. Growth by acquisition, in my opinion, is growth. So from our vantage point, it's been easier for us to think about acquiring an additional $10,000 of MRR versus trying to grow our portfolio by that same amount. Whether that is just a restriction of our current portfolio companies, I'm not totally sure. They each all make around $5,000 a month. And, interesting that they are all kind of stuck at that point. I'm not sure if that's a market thing. I don't know if that's us. I don't know what that is, but it would be much easier for us to just go buy $10,000 of additional recurring revenue by, buying a new company than it would be to get there by growth on our existing portfolio. So after about 3 years, we are not looking for enterprise SaaS companies. We are looking for these little product-led growth companies. Our highest alpha so far has been on taking bets like with Cold DM, where we bought it for a few $1,000s. It was making peanuts. And now we've 10x'd it already and it's making a few thousand a month. That's where our highest alpha has come from, is taking those bite-sized bets, running our growth playbook, and kind of seeing what shakes out. So that type of thinking sounds and feels like venture. The only difference is, in our case, of course, we're not finding founders and investing cash, and then that's kind of the business model, and that's not really what we're doing, right? We're buying the thing and taking over operations. So if you asked me a month ago if I had to pick one area where we could only buy products in, I would have said sales tools. Even today, I still think sales tools are a great place for us to start. They tend to be easy to get customers for, relatively high churn, but you have a community of people that are willing to try new things. Generally, they're in sales, or they're founders, or they run an agency. They try a lot of tools. They pick what works best for them, and they kind of stick with it. Sometimes they will churn, right? Like so on SuperSend, for example, it's a cold emailing tool. People come, they have some idea, they want to test it, it doesn't work, or and then they kind of churn. But then 3 months later, they have a new idea, come back, try again. There's a lot of that. So on a relative basis, I think sales tools have slightly higher, let's call it structural churn than maybe some other industries, especially compared to those enterprise SaaS companies that I mentioned, or boring enterprise SaaS companies. But still, I think they're plenty good businesses, and they're relatively easy to start and get up to a few thousand a month. I mean, for us, before WorkCloud, we were making about 26, 27,000 a month. After WorkCloud, we're making about 15 to 20 a month. And so, we're not talking about huge wins that we need to get to break even, at which point we can start to make more interesting bets. However, after thinking about what is an emerging technology where we could actually get even higher alpha than taking these bets on these tiny SaaS companies that we could pick up for, under 10, 20,000. I think I'm looking at, like many people are, large language model enabled or generative AI enabled applications. I've been doing stuff in machine learning for a long time, and I really do feel like this time it's different. These tools are just so immediately valuable and immediately useful that I think the hype is real, and it's worth investing in and having some bets in this area. So circling back around, what does this mean for us in a real practical way? One, I think we're going to continue to be opportunistic. Two, I think we're going to continue buying product-led growth companies over more enterprise SaaS looking companies. That being said, if a cool enterprise SaaS company comes along, I think that it would not be out of scope for us to just say yes to that, knowing better what we're getting into now than we did previously and how operationally intensive it can be. I think we'd be at least better prepared mentally, and we have some tools at our disposal now we didn't before to be able to handle that a little bit better, but a strong preference for product-led growth companies. Third, I do believe that we should be making vertical bets in the generative AI space. I think most of them will go not necessarily to zero, because these, again, I wouldn't say that we're going to be making venture bets, but I do think hundreds of millions of dollars of value has already been created, if not more, and will continue to be created in this generative AI space. And I want us to have some irons in that fire. And I don't know that that means we'll be buying all of these types of tools. It could be that we build some of them too. I know that that might be slightly confusing, given that XO is a micro private equity company. We're supposed to be buying software companies, not necessarily building them. However, I'm a software engineer, and if I can build something for us for free and it only takes me a couple weeks, then that is another way for us to get some alpha. That is another way for us to win. And frankly, at this stage, I don't really care that much how we win. I just want to get there. And if that means we have to deviate from buying SaaS companies to building some to get there, then so be it. So I hope you enjoyed these meanderings on our non-thesis thesis. If you want to read more about what we're up to and our current thinking on micro private equity and building and buying a small portfolio of SaaS companies, you can check us out at notes.xo.capital. And thanks for listening.